Corporate debt. It's this amazing tool that can build empires, but at the same time, it can be the very thing that brings them crashing down. In the grand architecture of modern finance, leverage plays these two totally conflicting roles. On one hand, it's a mechanism for powerful discipline. On the other, it's a source of profound fragility. And that's exactly what we're going to unpack today.
All right, so here's how we're going to tackle this. First, we'll start with the fundamental question of control over capital inside a company. Then, we'll dive into the two faces of leverage. First, looking at it as this tool for discipline, and then as a source of fragility. And finally, we're going to zoom all the way out to see how these choices, made by individual companies, can actually scale up and create risk for the entire system.
Okay, so first up, a question of control. We're going to shift our focus away from these, abstract market prices and get down to something way more concrete. Who actually holds the power over the money inside a company? And more importantly, how are their decisions shaped?
And this really gets us to the heart of the matter, the core question from our source material. Does leverage, taking on debt, does it ultimately make a company stronger and more focused, or does it just make it more vulnerable and unstable? Well, as you can probably guess, the answer is complicated.
So let's look at the first side of this coin, the idea of leverage as a form of discipline. In this view, debt isn't just about financing a project. Nope. It's actually a really powerful tool for corporate governance, a way to make sure a company is running as efficiently as possible.
And to really get why, we've got to talk about something called agency costs. This is like the classic problem in corporate finance. You've got the shareholders, the owners or principals, and then you have the managers, the agents, who are actually running the company. The problem is their interests don't always align, and that little gap can lead to some pretty bad decisions that hurt the company's value. Which brings us to what's known as the free cash flow problem. Picture this, a super successful company, and it's just sitting on a huge pile of cash. What's a manager tempted to do? Well, maybe not invest in the absolute most profitable projects, but instead use that cash on their own pet projects, things that expand their own little empire or boost their prestige, even if the returns are kind of lousy.
So how do you fix that? Well, this is where debt makes its grand entrance. It starts with that extra cash. But see, when a company takes on debt, it commits to making these fixed, regular payments. All of a sudden, that cash isn't free anymore, it's got a job to do. This forces managers to get serious and prioritize, to only go after the projects with high enough returns to make those debt payments. And just like that, their decisions get shoved back into alignment with what the shareholders actually want.
And this is really the key takeaway here. The choice to take on debt, a company's capital structure, it's not just some passive accounting decision. As our source material puts it, it is a strategic choice. It's an active decision to enforce discipline and shape how people behave inside the company.
But, and this is a big but, that discipline comes at a price. So now we're going to pivot and look at the other face of leverage, fragility. That very same commitment that creates focus, it also creates some serious vulnerability.
This slide just lays it out perfectly. It's the two sides of the exact same coin. On one hand, yes, the commitment that comes with debt reduces waste and forces people to prioritize. That's the discipline we've been talking about. But on the flip side, that same commitment crushes flexibility when things go wrong. It magnifies losses when there's a downturn, and it becomes a pipeline for transmitting financial shocks right into the heart of the business.
The reality is you just can't have one without the other. As the source states so well, discipline and vulnerability are intertwined. They are fundamentally completely linked. Because when a company with a ton of debt suddenly sees its revenue drop, the problem isn't just numbers on a spreadsheet. Oh no, it explodes into real-world chaos. Suddenly, customers get nervous, suppliers might start demanding cash up front, and your best, most talented employees, they start polishing their resumes and looking for the nearest exit. Financial stress turns into operational disruption fast.
And this is the absolute core idea of this section. Debt acts like a transmission channel. As the analysis notes, leverage transmits financial shocks into real outcomes. A dip in the market is no longer just a dip in the market. It becomes a full-blown crisis for the company's day-to-day survival.
Okay, for our final section, let's zoom out. We've been looking at what happens inside a single company, right? Now let's see what happens when we look at the entire economic system, because these little micro-level choices, they add up to macro-level risk.
This quote just nails the transition we're making. Sure, one firm taking on debt to keep its managers in line, that's one thing. But what happens when almost every firm does it? Well, what began as micro-level governance becomes macro-level fragility.
This is what we call the contagion effect. When an economic downturn hits, it's not just one company with a lot of debt that's in trouble. It's thousands of them, and they all react in the exact same rational way. They slash spending and sell assets to raise cash. But think about it. When everyone is selling at the same time, asset prices plummet. That weakens everyone's financial position even more, and you get this vicious downward spiral.
And there's a name for this crazy feedback loop, the leverage cycle. In the good times, rising asset prices make it easier to borrow more, and all that borrowing pushes prices even higher. That's the boom. But then the cycle reverses. Fall in prices force companies to sell off assets and pay down debt, which of course pushes prices even lower. And that's the bust.
So what this all means is that the entire economic system becomes pro-cyclical. Leverage acts like a giant amplifier. It makes the good times even better, but it makes the bad times so much worse. Corporate balance sheets stop being just a record of one company's health. They become the primary channels for transmitting shocks through the whole economy.
And this gets us to this incredible paradox. For any single company, cutting back during a downturn is the smart, rational move. Of course it is. But when everyone does the smart, rational thing at the exact same time, the collective result is a total disaster. It's a perfect example of how individually rational behavior can generate collectively destabilizing outcomes.
So when you put it all together, the big takeaway is this. The very same mechanism, debt, that enforces discipline inside one company becomes a massive source of instability for the entire system when everybody adopts it. A company's capital structure isn't just some internal affair. It's a fundamental building block of our entire financial architecture.
And this all leaves us with a really profound and frankly unresolved question that our source material poses. Knowing about this deep tension between discipline and fragility, how can societies organize risk-sharing mechanisms without creating systemic vulnerability? It's the central challenge for modern finance, and there are absolutely no easy answers.
This entire analysis is drawn from the report, The Architecture of Modern Finance, by the Bank and Finance Consulting Group. It's a really fascinating look at the hidden forces that shape our economic world. Thanks so much for joining me for this breakdown.